Welcome to the deep dive. Our mission today is, well, it's a simple one. We are tackling the incredible growth story of Afterpay.
Hmm.
You know, this small Australian startup that basically defied all the traditional banking rules and grew into a $29 billion global phenomenon.
In under 7 years.
Yeah.
It's an unbelievable trajectory.
So we're going straight into the sources you've provided, which really detail this whole thing.
And the central question we really have to answer is the business model. I mean, Afterpay famously charged consumers zero interest.
Right. No interest.
Yet it achieved this hypergrowth and, profitability.
Mm.
We need to dissect its unique hybrid strategy.
Specifically, why were retailers okay with this? Why were they willing, even eager to pay these massive merchant fees?
Fees far higher than Visa or MasterCard. And that single financial inversion, that flip, is the key to understanding all of it.
Okay, so let's unpack this. The story starts in Sydney, right? Around 2014.
Yeah.
And it's rooted in this huge behavioral gap. We're talking about millennials, and then pretty soon after, Gen Z.
A consumer base that was just deeply, deeply skeptical of credit.
Totally. They saw the fallout from the 2008 global financial crisis. They wanted control. They wanted transparency. But they absolutely did not want the trap of revolving debt.
And that recognition, that was the foundation of the whole innovation. The founders were sort of the perfect pair to solve this.
Right, you have Nick Molnar, this young entrepreneur.
24-year-old, yeah.
Who saw customers for his online jewelry store just abandoning their carts all the time. They couldn't afford the full cost up front.
And then his neighbor, Anthony Eisen, a seasoned finance pro who knew just how clunky and flawed the old payment systems were.
So they put those two insights together, and they created the core idea, buy now, pay later, BNPL.
4 equal interest-free installments. And the crucial part is, Afterpay takes the risk, but you, the consumer, you get the product right away, that immediate gratification.
And this is where the behavioral psychology really, it just kicks in. Afterpay positioned itself right away, not as a credit product.
Which had all those negative connotations. Exactly. They positioned it as a budgeting tool. Something transparent, something you could control. It was designed to feel safe.
Okay, so let's drill down into the mechanics then. Because that seems central to how they limited their risk and also reinforced that whole idea of it being a responsible tool.
The whole mechanism was built for discipline. So, step 1. The customer pays the first installment up front.
Immediately.
Immediately. And this is vital. It's an instant reduction of fraud risk, and it's a psychological commitment from the buyer.
Okay.
Then the other 3 installments are just automatically deducted every 2 weeks.
But the real structural genius, I think, was what happened if you missed a payment.
Yes.
With a traditional credit card, you miss a payment and bang, the interest starts piling up, you get late fees, and you can spiral into that revolving debt trap.
Afterpay just removed that lever, that core bank profit lever. It's gone. If a customer missed a payment, their account was instantly and completely frozen.
Frozen.
Yeah.
So you couldn't buy anything else.
Nothing. The account was locked until the debt was cleared. There was a small late fee, sure, but the company could never profit by letting a consumer fall into that long-term compounding interest debt.
And that clarity must have built a huge amount of brand trust.
Immense.
So, okay, if they're not making money from consumer interest, where did the $29 billion valuation come from? I mean, this is where it gets really fascinating.
Because they completely flipped the traditional financial services model. Just turned it on its head.
They pivoted entirely.
Entirely. They built a model on responsible, short-term, predictable spending. And they made the merchants their source of income, not the consumer.
And that strategic pivot allowed them to scale so fast without worrying about, maximizing how much consumers defaulted.
Which is the lifeblood of so many traditional credit providers.
The profit engine was the merchant fee. But here's the friction point. The sources suggest a typical credit card, like a Visa, charges a retailer, between 1.5 and 2.5%?
That's about right.
Afterpay was reportedly charging between 4 and 6%.
Yeah.
I mean, that is a huge margin for any retailer to swallow. How did they possibly justify that on their balance sheet?
They weren't just a payment method. This is the key. They were a powerful, quantifiable marketing engine.
A marketing engine.
So retailers looked at that Afterpay fee not as a transaction cost, but as a much better cost of customer acquisition and loyalty.
They were bringing in guaranteed buyers.
Guaranteed, high-intent buyers who specifically hated traditional credit options.
So that blending of FinTech and digital marketing, that's the real genius of the hybrid model. They're selling traffic and conversion, not just processing a payment.
Exactly. And we can actually quantify that value directly from the sources you sent over.
Go on.
For retailers who integrated Afterpay at checkout, they consistently saw two major benefits. First, conversion rates often doubled, sometimes even tripled.
Wow. So fewer people abandoning their carts.
Way fewer. And second, the average basket size, the average order value, it increased significantly.
Because consumers felt like they had more flexibility. They could add one more item.
Exactly. So the retailer's looking at this higher fee, but the massive increase in sales volume and that bigger average order value, it more than paid for the fee.
It's an effective financial arbitrage. They're paying a premium for a guaranteed sales lift and instant access to a demographic they might not have reached otherwise.
That's the perfect definition of it. They bought sales velocity. And then, on top of that, Afterpay started driving traffic directly to retailers from its own app, from its own website.
So the transaction fee was also a lead generation fee.
Right. No credit card company was ever offering that kind of marketing value.
And this choice, to rely on merchants is what let them keep such a disciplined risk model, even while they were scaling at this insane pace.
The risk model was so conservative. It was built around control. They capped the consumer's total exposure, limited how many active purchases you could have,
Payments were automatic.
always automatic. And critically, they stopped customers from taking out new BNPL plans until all the old ones were paid off.
That prevention of the snowball effect is so important. It's the complete opposite of revolving credit, which basically encourages you to roll over your balance.
Mhm.
But weren't critics worried that people would just, game the system? They'd sign up for Afterpay and Klarna and Affirm and just rack up micro debt across 5 different companies.
Oh, that was absolutely a legitimate concern for regulators and for consumer groups, especially as the industry got bigger.
Sure.
But Afterpay's internal loss rates stayed remarkably low,
Yeah.
significantly below traditional credit card issuers. Their algorithm was just really, really good at assessing one thing. Can this person handle this one single short-term repayment right now? Not their whole life's credit history.
And that disciplined approach is what fueled that initial hypergrowth.
Yeah.
They went public on the Australian exchange in 2016, just 2 years after they launched.
Incredible.
But the real turning point, the thing that made them a global player, was the push into the U.S. market.
The American market, it solidified their position so fast. The U.S. consumer was already used to a credit culture, but Afterpay just resonated perfectly with the younger shoppers.
The ones who were wary of credit cards or maybe had thin credit files so they couldn't get one anyway.
Exactly. And the timing was just perfect.
Right, the explosion of e-commerce.
Everyone was moving online, looking for frictionless ways to shop, and they signed these huge U.S. partners almost instantly. Sephora, Urban Outfitters, Nike, Foot Locker.
So Afterpay just sat perfectly at that intersection of e-commerce growth and this new consumer demand for predictable payments.
And what's wild is how quickly it became a cultural thing. The ability to Afterpay, it became an expectation for Gen Z shoppers, became a default option like PayPal or Apple Pay, but with that extra layer of budget control.
Okay, so we have to turn to the friction point, right? Regulation.
The inevitable friction point, yeah.
As BNPL just exploded, regulators in Australia, the UK, the US, they all started scrutinizing these companies. If it looks like credit and it acts like credit, but it's not regulated as credit, well, that's a problem.
The concerns were pretty focused. They pointed to weaker credit checks compared to banks and just a general lack of formal consumer protections, especially in the early days. It was a totally new category operating outside the old frameworks.
And Afterpay's response here was under a microscope. Some of the sources suggest that their early changes, like capping late fees, often came after a lot of media or government pressure. So were they really being proactive here, or were they just being politically very, very agile?
I think it was a mix of both.
Yeah.
They were certainly agile, no question. They knew very quickly that their survival depended on legitimacy. So instead of fighting the regulators head on, they kind of pivoted.
They embraced the conversation.
They embraced it. They tightened controls, and they actually started partnering with regulators to help shape the new industry standards. And that built trust, not just with consumers, but with the whole financial community. It positioned them as a responsible leader in this new sector.
And that move, that sort of self-regulation, proved to be the final strategic pillar before the ultimate validation.
The climax of the story.
The climax, 2021. The payments giant Square Jack Dorsey's company, now it's called Block acquires Afterpay for $29 billion.
Still the largest acquisition in Australian corporate history.
It's unbelievable.
And that deal was more than just a purchase. It was this powerful statement that validated innovation coming from completely outside traditional banking.
So why the huge premium? What did Square see?
They needed instant access to two things. One, Afterpay's massive network of merchants. But even more critically, its young, credit-averse, highly engaged user base, which they could just plug straight into their Cash App ecosystem.
It was a massive customer acquisition play.
A huge one, leveraging the marketing engine that Afterpay had already built.
So what does this whole story really mean for you, the person listening? I think it teaches some really powerful lessons about strategy, especially in FinTech. Innovation really does start by just observing those unmet needs. In this case, flexible spending without the fear of debt, and that the absolute backbone of a sustainable business is just ruthless, disciplined risk management.
Absolutely. I mean, Afterpay proved that financial services can actually be simple and transparent and kind of human-centered.
Yeah.
Its success wasn't about complex financial instruments. It hinged entirely on recognizing a behavioral shift away from debt and then pivoting the business model to monetize the marketing value it brought to merchants.
That arbitrage, that gap between the sales lift and the transaction fee, that was the magic formula.
That was it.
Afterpay really showed that innovation doesn't always come from, deep pockets or old legacy networks. It came from watching how people genuinely behave and then designing a product that just fit naturally into their lives. Which leaves you with this final provocative thought. If the future of payments was successfully captured by a company that focused on the merchant and on behavioral psychology, what other services? What other things dominated by traditional systems like, wealth management fees or complex insurance policies are just ripe for disruption? What other unmet needs are out there just waiting to be solved simply? That concludes our deep dive into the Afterpay model. Thank you for sharing your sources with us.